while Britain is on the verge of a cataclysmic financial crisis. Even almost 4 decades later, it remains an event scarred into the memory of the financial market after a violent storm had ripped across the country, knocking down trees and shuttering roads. Trading systems that still relied on brokers shouting at each other across open floors had closed early for the weekend as the damage was cleared up. As London trading reopened on Monday after closing jitters in New York the Friday before, the reaction was swift and brutal. The FTSE 100 fell 11 PC in a single session, while the United States, the Dow Jones ended the day down by a terrifying 20 PC. It became known as Black Monday, the worst single day of trading since the great stock market crash of 1929 and the one that shaped policy for the rest of the decade. As we approach October 19th, the 36th anniversary of that fateful day, could the British and global market be heading for a replay? To many financial experts, there are already warring parallels between the two eras. The bond markets are crashing around the world just as they did in the run-up to the crash of 1987. Debts have been ramped up, the equity market are overstretched, with company values stretched to the point of breaking in many cases. Now, a seemingly indestructible bull market is coming to an end. It is not hard to see how that could end in a gale of destruction blowing through the markets. If it comes to pass, a market crash on the scale of 1987 will prove a cataclysmic political and economic event. It would send interest rates soaring, increasing costs for mortgage holders and for highly indebted companies, especially in the property sector. Businesses would fail and pension fraud would be hard. Perhaps most importantly of all, the already high cost of service and national debt would climb even higher. It would force profligate politicians to finally face up to the consequences of their wild spending. There's plenty about the financial market over the last few weeks that looks very similar to the late 1980s. There is, however, an important difference. Policymakers still had fiscal room to respond to the crash of Black Monday. After 2 decades of easy money and constant buffering of the stock market with quantitative easing to prevent a crash, that no longer exists. It remains to be seen whether we witness a rerun of 1987. One point is certain, however, if we do, this time around it will be far worse. Bond market blitz. Investors are beginning to fret about a repeat of Black Monday, primarily because of the sell-off in the bond market, where companies and government issue debt and promise a guaranteed rate of return. Usually a sleepy corner of financial market, the bond market has been gripped by a wave of selling in recent weeks. Yields have spiked to levels that even seasoned market professionals can barely remember. The yield on the 10-year U.S. Treasury bill, the key instrument that determines price across the world, was close to 4.9 PC on Friday, a level not seen since 2007. In Britain, the government is now paying above 4.5 PC on a 10-year gilt, significantly more than when Liz Truss supposedly crashed the economy a year ago. The Italian government is paying close to 5 PC, the highest level since 2011, when the Eurozone came close to falling apart. Germany, which has had negative yields for most of the last decade, meaning investors will effectively charge a fee for lending money to the government, is now paying close to 3 PC. In every major market, the cost of money is rising rapidly. The bond market does not get the same kind of attention as equities or property. Most of us are not aware of owning any bonds in the same way as we might own our home or a portfolio of shares. But bonds are the crucial underpinning of the financial system, and your pension fund will certainly own lots of them, as will your bank, while your employer and of course the government will depend on the debt market for its financing. In total, the global bond market is worth $133 trillion, approximately 109 trillion pounds, or rather it was when it was last properly measured in 2022. When it crashes, it has far more impact on the everyday economy than any other part of the financial system. Higher interest rates are not transitory. There is no great mystery about why prices are crashing, and as a result, yields are going up. Investors are beginning to believe interest rates will remain higher for longer than previously thought. As a result, they are demanding a higher rate of return on the investment. 100-year Austrian bond that pay out 0.85 PC no longer cut it. The latest surge in government borrowing costs began with messaging from the U.S. Federal Reserve in early September that interest rates will need to stay higher for longer. Continued strong jobs figures in the world's biggest economy have also stoked concerns. A tight labor market drives inflation. Bond yields lurched higher on Friday after figures showed the U.S. economy added nearly twice as many jobs as expected in August. Investors and economists are also concerned about the high level of government borrowing. Both Italy and France have raised their interest deficit forecast over the last month and show little willingness to bring borrowing back under control, while President Biden's wild spending carries on regardless of the impact it might have on the economy. In the background, the huge spike in inflation in the wake of the COVID pandemic and the situation in Ukraine has proved stubbornly resistant to high interest rates. The central bankers who only a few months ago complacently assured us that the rise in prices was merely transitory have started to concede that inflation has become embedded in the system, the way it did in the 1970s, and that rates will have to stay higher for longer to control that again. We won't be seeing a rate of less than 1 PC again for a long time. The result, bonds have been massively repriced, even 5 or 10 years out, for a world in which money is far more expensive than it has been for a generation. There are plenty of warning signals elsewhere as well. In the US, there was a small-scale panic in the spring prompted by the collapse of Silicon Valley Bank, caused at root by its overexposure to a falling bond market. Only intervention from the Federal Reserve, in much the same way as the Bank of England had to step in over the LDI debacle, prevented that from spreading to other banks in the US, and several other regional financial institutions were hustled into mergers. Growing global debt mountain. If the financial contagion does spread, the main casualties are not hard to work out. In the UK, we've already witnessed a steep rise in mortgage rates and some modest falls in house prices. But if there's a full-blown crash, it will get much worse. It is just as bad elsewhere. In the US, the average mortgage rate has hit 7.5 PC, the highest level since the millennium. House prices are falling at an annual rate of 7 PC in Germany, the steepest decline in 23 years. A market crash will be felt by companies that borrowed cheaply and complacently assume that the rate would never rise again, especially in the private equity industry. The sector bought up huge swathe of the economy with cheap money and will have to start selling at huge losses once all that debt has to be refinanced at far higher rates. The consultancy firm Verge and also estimated in a report last week that $500 billion of corporate debt will have to be refinanced next year. All of those companies will find that they have to pay far higher rates, putting pressure on their businesses. But it will be felt most painfully by government for the simple reason that they have borrowed so much over the last decade. In the UK, the cost of services, our huge debt mountain, has risen to £100 billion a year, double the amount only a year ago, and almost 11 PC of total government spending. In France, debt costs are now the biggest single budget item, forcing the free-spending Macron government to make savings elsewhere. Interest on Italy's debt already consumes 4 PC of GDP every year, and that is only going to rise as it borrows more and more simply to stay where it is. In the US, interest payment on the national debt are forecast to rise from $475 billion last year to $1.2 trillion by the end of the decade. All President Biden's investment in the green technologies will have to generate a huge return to make all that borrowing look worthwhile. Now, in reality, all the major governments across the developed world will have to start cutting their spending and reducing their borrowing simply to bring their costs under control. Add that all up, and it's going to be very tough to adjust to higher rates. What would happen if there was a financial crash as spectacular as the Black Monday collapse in 1987? Back then, we didn't have a big recession in the UK, for example, until the early 1990s, says Neil Sharon, chief economist at Capital Economics. This time, the UK economy is adjusting to a sustained period of rate rises, which means the economy is already struggling. There will be no buffer for a shock. Western economies lose their luster. There are some big differences between 1987 and 2023. The overall debt levels were far lower back then, and government debt far less burdensome. In the US, the debt to GDP ratio was just 48 PC then compared to 120 PC now, and the UK was also comfortably below 50 PC compared with 100 PC now. Interest rates were significantly higher, and households and companies were holding significantly less debt, which gave them a lot more flexibility to cope with the crash. Perhaps more significantly, governments had already started the hard work of making their economies more competitive. The 1987 crash came in the middle of the Reagan-Thatcher project of rebooting the Western economies, curbing the overwhelming power of the trade union, privatizing inefficient state-owned monopolies, and handing power back to companies and entrepreneurs. All of that was just starting to pay dividend, unleashing a wave of innovations and growth that enabled economies to grow even through periods of financial turbulence. That is not to say it didn't matter. The loosening of the financial policy in the wake of the Black Monday crash led to a round of inflation that arguably led to the fall of the Thatcher administration in 1990 and the defeat of Reagan's successor George H.W. Bush in 1992. But it also came at a time when the major developed economies were getting stronger. That is certainly not true today. In reality, all the Western economies have been steadily enfeebled over the last 15 years. State spending has grown exponentially, much of it paid for by printed money. Regulation has been endlessly increased, government have been captured by lobby groups, and corporations have fallen under the sway of ideologically driven managers committed to social values instead of innovations and growth. The corporate raiders who disciplined bloated management hierarchies in the 1980s are a distant memory. The crash of the 1980s proved, in retrospect, to be little more than a punctuation mark instead of the closing of one chapter and the opening of another. That won't be true of the crash of 2023 if it happens. It may well mark the point at which 2 decades of relentless government expansions, increased welfare entitlement, and soaring debt levels, all of it financed by cheap money, starts to unravel. Government, corporations, and households will all have to start living within their means again, and growth will only be possible through greater innovations and productivity instead of through printing cash. When we look back from the 2030s or 2040s, that may well be seen as a good thing. A collapse will force us to focus on restoring real growth. There will be a lot of pain getting to that point. We have already seen that in the bond market over the last few weeks, and very soon we may see it everywhere else as well.